And if you want to worry, you can look at a bull market effort right now. We're seeing many houses just higher. At the Morgan Stanley shop, they are not. Michael Wilson is CIO, Chief U.S. Equity Strategist at Morgan Stanley. And one of your themes, Mike Wilson, is there's a complete misguess on the interstate game as addressed by the Fed today and followed by your Ellen Zentner. Wei Li there of BlackRock says persistent inflation. Is that a core reason for your caution in the equity market?
No, it's actually not, Tom. In fact, our view is that inflation is going to come down, and while that potentially is very good for bonds, it's not going to be good for stocks because that's where the earnings power has been coming from, right? This is really our boom-bust thesis. The reason we were so bullish in 2020 and 2021 is because we expected inflation to drive a profits boom, and now when inflation comes down, you're going to have a profits recession. So that's really where we're differentiated from an equity standpoint. You know, Ellen, as you know, is looking for a pause today too. She's not looking for any more hikes really the rest of this year, but a very slow path in terms of cutting next year.
What are you looking at going forward in terms of client responses, how they push back against the bearishness that you've been expressing?
Yeah, look, I mean, we're in a weird situation now because I feel like on the fundamental side, our earnings call has been spot on. So a year ago, just to kind of remind listeners, we were calling for an earnings recession and we were somewhat dismissed. But of course, now we're in one. And the only difference now is that we're just saying it's going to persist. Whereas I think most people, the pushback is, no, the earnings recession is over. And we're going to see a reacceleration in growth in the second half of the year. And that's what the consensus is forecasting. So that's what the pushback is.
So in other words, you're saying that you got it right if you strip out some of the big tech names and that there was an earnings recession that played out in lower valuations of some of these shares. And you're saying it's going to continue, not necessarily talking about the headline level of the S&P as much as these particular stocks fighting against the idea of a broadening out of the AI rally. Is that correct?
Well, actually, the technology stocks had the biggest earnings recession. I mean, you look at the communication services and some of the technology stocks, their earnings were down significantly in the fourth quarter. That's why they sold off so sharply in the fourth quarter. So they had an earnings recession last year, and the presumption is that's over. And now that's going to reaccelerate. And that's where we disagree. We think that including tech, not just tech, but overall the earnings recession is going to persist into the second half of the year. It's going to get worse before it actually improves next year.
If we get a Zentner economy or Ed Hyman moving down to 3%, dare I say under 3% inflation, David Rosenberg up in Toronto clearly in that camp as well. I'm thinking of the partial differentials on the income statement to get to the Wilson earnings call to get to 3,900 or whatever on SPX. And to me, it's all at the revenue line. And that is the core of your call with your security analysts that revenue growth will disappoint.
That's exactly right. So last year, the earnings recession I just referred to was all a cost issue, right? These big tech companies overinvested, thinking the pandemic boom was going to continue at the same pace. Of course, it did not. And that was a problem for discretionary, consumer discretionary, as well as some of the financial companies, et cetera, companies that overinvested. Now, what we're going to see is the top line disappointment. Okay, maybe it's not a recession, but like Ellen's forecast is 0% GDP growth effectively. That's going to feel like a recession because your pricing is going to evaporate. And we're seeing that now in goods. So there's this big dichotomy between goods inflation and services inflation. I mean, goods inflation is back to the 2% level. In fact, it's probably going to go deflationary for a lot of businesses. That's your revenue growth disappointing.
How do you allocate here? Do you participate in the market, or is cash a very comfortable place to be?
Both. So, and look,
that's a strategist answer, both.
Yeah, on one hand and the other hand, right? So take my economist hat. But look, I mean, in all seriousness, cash offers you a great risk-adjusted return. We're overweight cash. Okay, there's nothing wrong with that. But we still are fully invested in equities, too. We're just underweight our normal allocation. And we've been that way for the last 18, 24 months.
I think this is misunderstood, Lisa. I think people look at Wilson, they go, get out of the market. And this is a hugely important issue.
Every time he comes on, he says, I'm fully invested. It's not a matter of just simply hiding under a mattress. My question is, what happens if there's a recession and nobody cares? What happens if there's an earnings decline and people shrug it off and say, well, look to the future and there's going to be this incredible American exceptionalism, and where else are you going to put your money?
Well, this is our story for 24 and 25, right? This is why we're in a difficult situation right now where we see the near-term risk reward is lousy. But if we look out 24, 25, this is what people are getting excited about. Capital expenditure boom for things like reshoring, green energy, traditional energy, retrofitting buildings, et cetera. And now, of course, AI. So this is exciting. The problem is it's a cost first, and then it's a productivity benefit.
Well, people are looking past it. I mean, this is sort of the frustration when people say that there's a divergence between bond markets and stock markets. They say, well, the bond market's looking at the now, which doesn't look very good, and stock markets are looking to 24, 25. What's to make them look at now? now, right? What's the catalyst to bring them down at a time when people can look past near-term pain and see what you're seeing?
Well, typically it's price. Okay, so we're very disciplined on price. We always get kind of categorized as a perma bear, but I remember calling the low in October. We called the low in March of 2020 because of price. So we're very disciplined. Most people are not disciplined because of FOMO, and that's just the nature of markets. Markets are momentum driven. It feels better when they're going up. It feels better to buy things when they're going up, and that's where we are now. So the risk reward in the short term is lousy. So I think it's going to be price, Lisa, which will change people's minds. Now we could be wrong. Maybe we don't get a fatter pitch that we're hoping for, but we're also not worried it's going to run away from us, and we can buy the stock market kind of right here, probably 12 months from now.
What's the market bet right now? Because I see a lot of indicators that say people are comfortable with Mike Wilson's calls. They're really afraid of this bull market, and they're cautious. What is the bet that Morgan Stanley sees by the investment public, by the hedge funds, by long-only buy-side institutions?
Well, I think once again, our view is that I'm in a position of luxury. I don't have to put capital to work every day for monthly performance. We have asset allocation, which is kind of measured on a longer-term basis. So I have the luxury of time. Right, so our asset owner clients have that advantage, and that's what we try to take advantage of. Folks who don't have the advantage of time have to kind of participate at the worst possible moment, and that, by the way, it also includes at the lows. Right, so the opportunity that was created in March of 2020 is because people were being forced to divest, and we were happy to pick up those shares at cheap prices.
What do you think is the most overpriced aspect of the S&P right now?
Well, I think this is an interesting question because most people assume it's only 10 stocks. That's actually not true. The median multiple for the S&P 500 today is the same as the market cap weighted multiple. It's close to 19 times, 18 and a half, 19 times. So it's a very broad overvaluation. Now, I would say the sectors that are cheap, okay, the only ones that are appearing cheap now are energy and financials. The question there, of course, is what are the earnings going to do? Because they're cyclical businesses.
Well, focus on energy there. You got 20 seconds of energy there. Is that the place to be?
Well, I think energy at the stock level, there's definitely opportunities, and in financials too, right? So like the regional banking crisis created opportunity in individual financial services stocks, and I think that's what we're trying to do now. We're trying to find these one-off opportunities as opposed to worried about the stock market overall.
Mike Wilson, thank you so much. With Morgan Stanley here with a call. 3,900 is where you are now. You want to make some news here?
3,900 year end, yes, sir. We're still there.
Okay. Going to let us know if you change any
be the first call.
Thank you. Mike Wilson,
Middle of the
Morgan
night.
Stanley here.